Hi friends, so let's start with today's analysis. I think the talk of the town is the trade war. So we'll start from there straight away. Yes, so Mr. Trump has started the trade war. He has put sanctions on Canada and Mexico by 25% and 10% on China. Although it was known to the markets, but they are reacting now. Dow futures were around 600 points down, and Nasdaq futures were around 400 points down. So approximately 1.5% or 2% indexes were down in terms of futures for US markets. These sanctions will be applicable from tomorrow night onwards. So we have one more day to negotiate and probably find a solution. Mr. Trump has told that he'll be talking. He's ready to talk with the Canadian and Mexican authorities to find a middle path. Let's see how it goes. But because of that, what has happened is the dollar index has inched very high. It is now hovering around 109.5 levels. Bond yields probably has not showing any sign of strength as of now. It's around 4.54. And rupee has again gone to all-time low of 87.2. And if this trade war continues, probably we'll be looking towards 89.90 levels. That's the worst part of rupee can go. Now, what is the implications of this sanction? So, the implications are both ways, and that's the reason why U.S. markets are also down. So, Mr. Trump, during his election campaigns, has always been telling that we want to have a mega policy. Mega means make America great again. So that MAGA policy also gets a hit because of all these things. So it is estimated by the economists that putting by these tariffs, U.S. inflation will again cross 3%, which actually the Fed wants it to be around 2% to allow the interest rates to happen. The market would be anticipating that there will be no rate cuts now for the entire calendar year. And also the GDP estimate of US will go down by around 1.5%. So these are the bigger implications on US, and certainly Trump also does not want that. That is why he's again and again shifting the dates. He wanted to announce the sanctions on his inaugural day itself. He did not do that. He shifted it towards 1st February. 1st February also, he has given a timeline up to 3rd, let's say tomorrow night, to find a solution. So he is also not very eager to put sanctions. He also want to find a solution to it. Only thing is who starts first and by how much. In response to this, Mexico has also told that they will be putting sanctions. They are not announced. Canada has announced counter sanctions of around 25% on 1643 products. So probably I think $108 billion of imports that they do from America. They also told their people and stores to take off their US beers and alcohols and other US projects which they can dispose of. So the hit will again go to the US as well. Canada, which is going around 1.8% of GDP, if these sanctions remain, will get into recession within 6 months or 1 year, and their GDP will be trading at around minus 1.8%. Similar is Mexico. Mexico will also undergo into a severe recession because they are the major trade partners with US. They export a lot to US. So if these sanctions happen and probably their goods become costly, there'll be alternate countries who will be who will be giving the supplies to the US, and that's the reason why we'll see an inflation. We'll see a depletion of GDP rates for Mexico and Canada. Both the countries have still told that the solution can be found out by talks. We are not in. We don't want to have a war as such, but that's how it is. Let's see tomorrow if today evening we can find a solution or not. Mr. Trump talking to these people, and let's see how it happens. China markets is closed, and China has only told that we'll be complaining this to the WTO, World Trade Organization. They have not announced any counter tariffs, which means China also wants to have a dialogue, and they also wants to find a solution by talks. So this is what the rhetoric was. This is what Trump wanted. He only wanted people to come on the negotiation table and find solutions. And according to me, I think the solutions will be sought very soon, if not today, within some few days. But the solution will be fought because it is not good for neither of the countries. Neither China, neither Mexico, neither Canada, not even US. More importantly, not even US. So if Mr. Trump wanted that his country should become great again, this is not the way. So this will not last much. I will not be surprised if the solution comes to certain extent today itself. Let's see how it happens. We'll be having close watch on that. China anyways has not announced any counter sanctions, which means China wants to have a dialogue. Now we come to the Indian market. So Indian markets, because of this news, was trading down. The SGS Nifty was showing around 200 points down. We opened lower. We slightly went below that, but probably we are trading in the range of around 150 points down throughout the day. Average, we can say, although we closed around 110, points down. And even the Bank Nifty was around 0.5% down. So 0.5% cut, we can say, on Bank Nifty and Nifty, which is much less as compared to what the European markets have undergone. They have undergone around 1.5% cut. Taiwan index around 3% cut. Japan market for around 2%, 2.5% down. And US markets futures also trading around 1.5 to 2% down. So India, if it is closed only 0.5% down, I think the major contributor was the budget, which did not allow a selling to happen. If this kind of news would have come before the budget and the weaker markets that we had 1 or 2 weeks before, we would have seen the similar damage or even more than that. So that shows that the market is liking the budget. There is resilience, and that's the reason why probably we'll still have a hope that we'll not be touching those levels of 23,000 or 22,800 on the Nifty once again. If this trade war does not intensify too much, which the chances are it will not. The broad index were under more pain. The small cap index was around 2.5% down, mid cap index was around 1.2% down. That because of repositioning of the portfolio. Most of the traders and most of the funds, they bought a lot of capital good shares, defense shares, railway stocks, assuming that the capex announcement will happen even larger in the last budget. With that hope, the market went into the budget, and that's the reason why repositioning of the portfolios are happening. People are opting out of defense, railways, and capital goods stocks, and they're entering into consumption stocks, to a certain extent, financial stocks as well, especially consumer finance. So this was the repositioning which is happening. Nothing to worry on that. As of now, Trump war is also not causing any big troubles. Yes, there's a knee-jerk reaction, but our markets have shown a lot of resilience today, which gives me a confidence that probably if any small news also comes on resolution of this trade war, which I think will today, tomorrow, or within a week or so, it cannot continue for weeks and months and year. India market is getting ready for moving towards 24,000 initially, and probably up to 24,000 depending on how the RBI policy comes out on 7th. This week we have three triggers. So we have this RBI policy on 7th. We have Delhi elections, I think on 5th of February. The result will be out on 8th February, and earnings are anyways going on. So we have these 2-3 triggers to watch out for. Apart from that, I think the major worry as of now for the markets is only this Trump, which he has started. How deep he wants to take it. But my view on this is it will not go deep. Probably it should get resolved within this week itself. Now, if we talk about crude, I think New York crude, that's an NYMEX crude, has seen a jump. Brent crude has also seen a slight jump because Canada and Mexico, especially Canada, supplies or exports a lot of oil to US, and they are supplying this oil in those points of America where they don't have too much pipelines and all. So they depend very heavily on Canadian oil. That is why the tariffs on oil and gas and other products, or other essential products, the tariff has been only 10%. So it's not flat 25%. That means that Trump is also playing it in his own advantage and does not want to go full flesh on this kind of a trade war. Uh, India also announced, if you see the budget, they've announced a reduction in import duty on the heavier bikes, which means we wanted to please Trump to a certain extent. We also want to give a signal that we are ready for talks and we are ready to reduce the tariffs, whichever you want to suggest to us. So we are ready to get into dialogue mode, and we don't want this kind of a trade wars, because anyways, these trade wars and all these things will not benefit anybody, and that's what I'm telling, not even including US. So that's on the part. Today we have selling in very heavily selling in defense and railways and capital stock. So I'll just take 2 minutes on that. What is bad, and is it really too much to be panicked on all these things? See, capital good stocks. If you see the budget has given you 11 lakh crores of capex, which is around the same which was there last year. But they have given additional budget to the states for around 2 lakh crores, and they've also given extra budget to the PSUs to spend in the form of capex. If you total all these things, it's around 17 to 18 lakh crores. It's a huge capex. There is hardly any capacity in India to absorb so much of money. The budget for railways has already become five-fold in light for last 5 years. The railways are struggling to spend even those. They already have orders for next 2 years. Whether it is defense, whether it is railways, capital goods, all have orders for next 2 years. Nothing to panic in those stocks. This is purely repositioning. They will find their bottom. It's an opportunity to buy when they find the bottoms. Probably you wait for another week or so. Nothing to worry on these fronts. The capex is still there. People have not seen the fine prints very deeply. In fact, for defense, the budget has been increased by 9% from the last year. And still you're seeing selling very aggressively in these stocks. That because of two things. One is positioning, and second because the stocks have run up very extremely fast in a smaller amount of time. So that's a small correction in terms of P which is happening. But considering the macro environment, considering the geopolitical environment, no country can afford to reduce their capex on defense. That's what India has also not done. It will not happen in future also. So if you find fundamentals of a company good, if you find the P ratings and the valuations to be comfortable, remain invested in the finance and in the defense stocks. In fact, you can even buy the levels when you feel comfortable in terms of your valuations. Even the railway budget has been kept flat. It has not been reduced. And as I'm saying, there is already a lot of orders with railway companies. Let them execute these orders. Then only we'll see whether there is a scarcity from government to not give further capex. It will not happen. Government has been giving larger capex from last 3 to 4 years. That is how they have driven the growth of the country from post-COVID. Now there was a turn to shift the focus on consumption because the economy was suffering due to it. See, one thing you should remember that this higher capex has not given us a very large growth. Once, first of all, second, not a very good it has been only K-shaped recovery. So it has not been a vertical recovery, V-shaped recovery. We only gone for K-shaped recovery, which means some of the segment has benefited out of it, but the lower segment has not benefited out of it. Moreover, the consumption was weak in urban sector, which was causing trouble. The capex was not coming from the private sector because the capacity utilization was hovering around 77% from last 1.5 years. Considering all these things, the government has taken a very good move. And it's a pretty balanced budget, which I've told on Saturday also. The capex is also there. It's a huge capex. So even if you see last 3 years, average is around 30 lakh crores of capex has been announced. It's a huge capex. If those kind of infra is being built, if it is already there, it will automatically be a multiplier in terms of GDP growth. But that capex has not been spent. It is just spending slowly and slowly. So I think that's not a thing to worry at all, and people should not worry on this. Uh, Another point which I want to bring it down here is that most of the people were only investing in US. They only wanted to buy dollars. I think that trade has also taken a hit. People have to now understand that you cannot depend entirely on only one basket. You cannot put your entire money only in US country, and that is what some kind of flip will happen now. And again, some money will start coming to emerging markets, including India. With this kind of a budget, I think it will excite FIs a lot because of two things. One, they've identified the weaker consumption areas, and they've taken steps to address that. Second, the fiscal deficit has been kept in control, which is 4.4% for FY26, which none of the big growing countries have been doing that. So if you remember, America fiscal deficit is around 8% plus. Similar is the range for China also. So people are spending a lot to gather the momentum in GDP. India is not doing that, which means we are into a very good fiscal prudence, and that will always keep the traction for money to come into a country always great. There might be some flips 1 or 2, 3 or 4 months, which is going on, but overall the budget looks good. It has set the path for 7 to 8% kind of a GDP growth from 2026 onwards. That's a great budget. It's a very fine balance. So FIS probably has come today only. Saturday there was a very less volume. It was only 3,000 crores gross volume. They have come today, and I think seeing the FIS action also, I don't think there'll be a huge selling from FIs. Although we had a gap down, but I don't think there'll be huge numbers of FIs. And you will see now a pivotal shift of FIs also buying into Indian stocks very soon. They have got the valuations towards a decent extent now. If you talk about valuations now, Nifty is trading below 10-year average now. It is trading below 18 years forward multiples of FY26. That means there is a very good valuation support now, and these are the levels to buy. I don't think, and today there was a lot of buying from DIS. So it's looking like DIS are will go full hog now. They've already seen the earnings. They know which sectors are good. They've seen the budget, and they've seen most of the triggers. They've also now seeing or just digesting this probably the Trump part, which is the last leg. And if that all, we also have a policy support from monetary support from RBI on 7. Who knows? The market can just have a bomb blast from here on. But the market looks good for, even from here on. So considering all these factors, I don't see the markets to fall below 22,000 or so, let's say January lows. I don't think at all. The market should look resilient from here on. We'll see upside at least till 24,000 in the first leg, and then 24,500. After that, we can review once again. Banks will again lead the show. They will gain a lot because even if there is a consumer spending increase or the money which is coming in the hands of people, they will put, either they will increase their EMIs, they will buy more probably homes, or the money will go into the capital markets in terms of more SIPs, and there'll be a lot of buying in terms of consumer durables and autos and all, for which again the loan is being given from banks and NBFC companies. So it's a huge positive for banks and NBFCs. I think they will lead the show. Overall, the things look good. Nothing to worry on this Trump thing, which I've already been telling also. And that's the reason why you see the least impacted thing is India. I've told you the indexes, how they went down. Taiwan is down by 3%, Japan is down by 2.5%, America is futures are trading around 2% down. India has closed just 0.5% down today. That's all. So we are already seeing a resilience. We're already seeing a outperformance from the world market. That's what I was telling. India will be least hit from this kind of sanctions, and it will continue. Considering all this, remain positive, remain bullish on Indian markets. That's what my opinion is. Thank you. Thank you for your time. Thanks so much.